Hey everyone, welcome back to another episode of Crypto Philly, your go-to pod for decoding crypto, taxes, and everything in between. I'm your host, Sean from CoinFlask, tax strategist, DeFi degen by night, and on-chain whisperer by trade. Today we're diving into a spicy but necessary topic, the IRS and crypto, what you should know. If you've been riding the bull, surviving the bear, or staking for your sweet yield, Uncle Sam wants to know about it. Let's break it down. No panic, just clarity. So, first things first. Why does the AI why does the IRS even care about your ETH, your Doge, your Solana Monkey NFTs? Simple answer, tax revenue. Since 2014, the IRS has classified crypto as property, not currency. That means every time you sell, trade, or spend crypto, it's potentially a taxable event. Buy Bitcoin? Not taxable. Sell Bitcoin? Taxable. Trade Bitcoin for Ethereum? Taxable. Swap ETH for an NFT? Yep, still taxable. Even something like staking rewards, airdrops, or mining income. Those are ordinary income in most cases. Tax when you receive them. Think you're off the grid because your wallet address is 0x anonymous? Think again. The IRS has partnered with blockchain analytics firms like Chainalysis and Elliptic. Exchanges like Coinbase and Gemini and Kraken already report user activity, especially if you're cashing out in fiat. And if you have filed taxes recently, you've probably noticed that little crypto checkbox question at the bottom of your 1040 form, assuming you're filing as an individual. What it says, or actually what it asks. At any time during the year, did you receive, sell, exchange, or otherwise dispose of any digital asset? Check no when you should have checked yes. That's called perjury. And yeah, they're watching. So let's talk mistakes, because this is where people get wrecked. Here are a few IRS red flags in the crypto world. Not reporting crypto sales or trades at all. Second, incorrect cost basis, especially if you are using multiple wallets. Third, forgetting about airdrops or staking income, red flag. Four, claiming personal use for NFTs when they're actually investments. Yeah, that's also a red flag. And last, over reporting losses to dodge gains. So, the IRS is aggressively auditing crypto users now. In fact, they have launched Operation Hidden Treasure. It sounds like a pirate movie, but is actually a task force hunting unreported crypto gains. Hmm. Oh, if Jack Sparrow was here to see this. So, what should you be doing to stay in the clear? Well, here's the basic checklist. First, track everything: the buys, sells, swaps, staking, and rewards. Then, use a crypto tax tool like CoinTracker or Coinly. Yeah, we've got affiliate links for those. File on time and report every wallet and exchange. If you don't know what you're doing, get help if needed, especially if you've been active on DeFi or NFTs. And if you think you've made mistakes in the past, consider filing an amended return or doing a voluntary disclosure before the IRS reaches out first. It'll save you from penalties or worse. So, crypto is all about freedom and decentralization. But tax law hasn't caught up yet. For now, you're playing in TradFi's sandbox when tax season hits. So don't treat taxes as an afterthought. Treat them like part of your crypto strategy. You don't have to love the IRS, but you do have to respect it, or at least not poke the bear. So that's it for today's episode of Crypto Philly. If this helped, shoot us a review, share it with your dial, or send it to one friend who thinks taxes are just a suggestion. And remember, when it comes to crypto taxes, don't get caught holding the bag. So until next time, stay liquid, stay compliant, and stay legendary.